Hello and welcome to our PwC's webcast on IFRS 9. I'm Gail Tucker, the Financial Instruments Leader in our Global Accounting Consulting Services practice. I'm joined today by John McDonnell, who's also a partner in our Accounting Consulting Services practice, but more importantly, he's an audit partner in our banking practice in Ireland. What we'd like to do today is take you through the changes that have come out of the most recent version of IFRS 9, primarily looking at the differences to accounting for the measurement and classification of financial assets, and then to look at impairment. So let's start off looking with classification and measurement. In IFRS 9, the standard distinguishes between equity and debt instruments. So for equity instruments, these are all measured at fair value on the balance sheet. But a company has an irrevocable choice to measure them at fair value through OCI if they're not trading investments. That hasn't changed from the current version of IFRS 9. So what I do want to focus on today is the accounting for the debt instruments, which is the bit that has changed. Now we now have three categories for accounting for debt instruments: amortized cost, fair value through OCI, and fair value through P&L. And to determine which of those categories you're in, we need to look at, first of all, the business model and then at the cash flow characteristics of the actual instrument. So let's start off with the business model. What do I mean by business model? Well, it's essentially the way that a company is actually just managing those assets to generate value and to generate cash flows. So does it hold the instrument just to collect its contractual cash flows? Does it try and sell it? Or does it both hold to collect and sell financial assets, its cash flows? If it's just holding it to collect its contractual cash flows, the instrument may be able to be measured at amortized cost. If the business model is both hold to collect and to sell, then it may be at fair value through OCI. If it doesn't meet either of those business models, it ends up at fair value through P&L. Now, having done the business model test, we then have to look at the cash flow characteristics. And this comes back to what's called the solely payments of principal and interest test, the SPPI as it's become known. So if we look at the instrument and say the cash flows are primarily that of repayments of principal and interest, similar to what you would have in a basic lending model, then that will be able to be eligible to be at either amortized cost or fair value OCI. But if it fails that requirement, then it's at fair value through P&L regardless of whether it meets the business model test to start with. And finally, a company could still choose to designate a financial asset at fair value through P&L if it reduces or eliminates an accounting mismatch. So in a very high level, that's the overview of the classification and measurement. Now, John, what do you think are going to be the challenges in bringing this in for real?
Well, Gail, this will be a huge issue for entities, particularly financial services companies. There will be significant judgments which will need to be made around the business model, and there will also need to be judgments made around the assessment and tracking of sales. Given that banks won't get any capital advantage from the new fair value through OCI category under the new Basel III rules, banks are starting to look at moving assets, or changing the business model to move assets into the amortized cost bucket, and the particular area of focus is the liquidity portfolio. This will be very challenging because there are significant tensions between the regulator's requirements for the liquidity portfolio and the requirement to sell that portfolio and the requirements under IFRS 9 for amortized cost. Another challenging area is where a bank originates loans and then sells some of them onwards. Here entities are looking at splitting their portfolio to ensure they get amortized cost treatment for the loans they retain. And the whole SPPI test is very complex. If you take, for example, if an entity acquires a loan book as part of a business combination at fair value, but those loans can be redeemed at par or prepaid at par, and there's no financial penalty or little financial penalty, they're likely to fail the SPPI test and therefore will have to be fair valued through the income statement on an ongoing basis. What entities are doing here is they're applying a two-pronged approach. They're looking at financial instruments on an instrument-by-instrument basis and considering whether they pass the SPPI test. If they don't, they're then considering whether they need those instruments going forward. And secondly, they're looking at refining their business model and splitting their portfolios to maximise their ability to get amortised cost accounting.
And it's a great segue into our next session, which is the impairment. So when we're looking at these new impairment rules, they're actually applying not only to the financial assets that are measured at both amortised cost and fair value through OCI, but also all loan commitments and financial guarantees as well. And I think it's important to remember that even for corporates, putting aside banks and insurance companies, even corporates will have trade debtors that will be caught by these impairment rules as well. So perhaps you can take us through what the rules are.
Sure, Gail. It's a much more forward-looking model. Impairment is considered by virtue of your expectations of loss in the future, not related to an impairment trigger in the past. IFRS 9 sets out a general model for impairment, and it has 3 stages. Stage 1, all assets are originated in stage 1, and impairment is measured using 12-month expected credit loss on day 1. That means you have a day 1 loss under this model. EIR is calculated on the gross carrying amount of the asset, that is, before impairment allowance. An asset moves from stage 1 to stage 2 when there is a significant deterioration in credit risk. This is a big accounting consequence, because the impairment gets now measured at full lifetime expected credit loss. However, EIR is calculated the same way as in stage 1. Assets then move from stage 2 to stage 3 when they become credit impaired, which is essentially they have an impairment trigger like the impairment trigger you would have under IAS 39. However, EIR is now calculated on a net basis rather than on a gross basis. Gail, one of the questions I'm most frequently asked is, how will my impairment provisions, how much will my impairment provisions increase by when I move from IAS 39 to IFRS 9? Now, a simple comparison is quite difficult here, and that's because we do not have an IBNR concept under IFRS 9, and the amount of IBNR a financial institution has at the transition date will impact the analysis. But I do think it's fair to say that most, or if not most, a large component of both stage 1 and stage 2 would not be in existence under the current IAS 39 impairment provisions.
So when we look at that 3-stage, the key criteria is whether there's been a significant increase in credit risk, which I guess is, how do you actually determine whether there's been that significant increase?
Well, whether the determination of a significant increase in credit risk is really challenging. Significant isn't defined by the standards. There's no bright lines. Credit risk is a very complex process. It's factual, and it is holistic. Trying to determine what factors to take into consideration, the relative weighting of those factors, is considerably challenging. The standard does give some guidance, but it's at a very high level, and the guidance is around changes in the market pricing for credit spreads, changes in credit grades, or changes in financial and economic factors that impact an asset. How you apply the assessment is you consider changes in the probability of default, and this is important, the probability of default, not the expected loss. And if you think about it, that makes sense, because we're trying to determine what is the change in credit risk, not the change in absolute loss. So what you do is you consider the probability of default over the remaining life of the instrument and compare that to the probability of default at initial recognition. Now this is important. A simple or absolute comparison of probabilities of default is not appropriate, because if you think about it, all things remaining equal, the probability of default of an instrument should reduce with the passage of time. And the best way to describe how the model works is to do it by way of an example. If you have a 5-year loan with 2 years left to run, you compare the probability of default for the remaining 2 years, not with the full probability of default of the instrument on an initial recognition, but with the probability of default at initial recognition of years 4 and 5. Now that's significantly challenging, because entities do not track probability of default in that much detail. The standard has 2 simplifications, if you like. The first simplification is that you can assess whether there's a significant increase in credit risk by looking at it at a counterparty level rather than an individual instrument level. Or secondly, for portfolios, you can determine the maximum amount of credit risk at which the entity would issue a loan from the portfolio, and then you do a comparison of each of the assets in the portfolio, the credit risk for those assets against that maximum credit risk. You can only do that for a portfolio where assets have similar credit risks. financial instruments, there will be a significant increase in credit risk well before there is objective evidence of impairment and well before there is an actual default event. For that reason, IFRS 9 favours forward-looking information rather than past due information or delinquency information. But that doesn't mean you can't use that information. If all you have available to you is past due information for an individual assessment of whether there's a significant increase in credit risk, then the standard requires you to do two things. The first is there's a rebuttable presumption that if you're 30 days past due, the loan must move from stage 1 to stage 2. And secondly, you must consider a portfolio assessment if forward-looking information is available for that portfolio, such as unemployment statistics. In those circumstances, you consider at a portfolio level whether there was a significant increase in credit risk, notwithstanding that you've already done an assessment on an asset-by-asset basis based on past due information. And the reason the IASB have that second layer is that they, as I said, favour forward-looking information as compared to past due information.
Right. So now we've worked out if there has been a significant increase, I guess we have to actually calculate what the actual expected credit loss is. And of course that's actually done on an expected basis. So it's actually taken the credit losses weighted by the probability of default. So if we've got the assets on the balance sheet, it'll be the comparison of your actual contractual cash flows with the cash flows you now expect to get on a present value basis. And if it's actually for undrawn down loan commitments, which are in the scope of this, I guess it will be the actual contractual cash flows if the customer draws down the loan compared to what we now expect to receive if they draw down the loan. And both of those present value calculations will use a discount rate based on the EIR, on original recognition. I guess when you talked about the different stages, I think it's important to say in that first stage where we're looking at the 12-month expected credit loss, it's actually a portion of the total lifetime expected losses for the possibility of default events in that first 12 months. And it's not the actual expected cash shortfalls in that 12 months, it's a portion of the total expected credit losses. So we've now looked at the sort of overview of the impairment model. Have they tried to make it easier for us?
Yeah, they have. There's a number of simplifications. The first is called the low credit risk simplification. And if an entity has assets which are low credit risk, it has an option to keep those assets in stage 1, if you like. It doesn't need to do a test to consider whether there's been a significant increase in credit risk or not. Low credit risk, they can remain in stage 1. That's of considerable benefit to insurers, because if you think about it, most insurers' assets are investment grade. The standard also looked at simplifying the process for corporates because it recognises that corporates do not have sophisticated credit management systems. So if you have trade receivables or contract assets without a financing component, normal debtors to you and me, if you like, the impairment calculation on those is done at full lifetime expected credit losses. There's no stage 1. The standard has an operational simplification here, whereby you can apply a provision matrix to determine the lifetime expected credit loss for trade receivables. And this simplified model is called the simplified model. For remaining assets, such as lease receivables, trade receivables with a financing component, contract assets with a financing component, entities have an accounting policy choice. Go with the simplified model or go with the original general model. So really what the standard is trying to do is trying to reduce complexity for corporates, and the provision matrix really works here. However, there's a cost to this. If you think about your normal debtor portfolio, the price to this is impairment now needs to be measured on all of that portfolio at full lifetime expected credit loss. You do not get the reduced 12-month expected credit loss here.
Yeah, okay. But there's some good news.
Yes.
So we've now gone through the classification and measurement requirements, the impairment requirements, and I guess it now comes, how do we get from where we are today to having implemented IFRS 9? So as I mentioned at the beginning, it's effective on a mandatory basis from the 1st of January 2018, but entities can adopt it earlier. I think it's important to remember though, if companies are in the European Union, it hasn't yet been endorsed, so I think it's a case of watching the space to see what happens in that regard. But for other companies that want to adopt IFRS 9 early, there is a requirement in the standard now that if they adopt it after the 1st of February 2015, next year, they have to adopt IFRS 9 in its entirety. So up to now, we've had the different elements that the companies could adopt, but from next February, they will have to do it within its entirety. I guess one exception to that is companies can adopt the own credit portion of the financial liabilities bit on its own. And the reason the ISB's brought that in is that a number of banks wanted to do that, but they may not yet be ready in their impairment model, as we've just heard, but still want to be able to adopt that bit, so they can just do that bit. The other thing to remember, I think, as well, is when they bring in IFRS 9, they have a choice on hedging. You can either adopt the new hedging that is in IFRS 9 or put all their hedge relationships under 39. And the reason the ISBs allowed that choice is because, as you mentioned, they're working on the macro hedging project, and they recognise that some banks won't want to disrupt their hedging relationships until they know where that's got to. So I guess that's where we are in how we get there. Any final messages, John?
Well, Gail, this is going to be significantly challenging, particularly for financial institutions. We need to consider the determination of our business model. We may want to change our business models. We need to consider the SPPI test, which is very complex. But currently, the credit management systems that entities use do not produce the information in the manner or to the extent that it's required by IFRS 9. So we're going to see significant changes to credit and information systems. Secondly, financial institutions are going to have to build up new expected credit loss models for the 12-month expected credit loss, where they can probably leverage off the Basel models to a degree, but much more challengingly for full lifetime expected credit loss, and people are grappling with how those models might actually look. There's significant judgments around the inputs that you put into those models. How do you define credit risk? How do you define default? And this is all going to take a considerable period of time to bed in. So I'd strongly urge people to get started if you haven't begun the process, because there's a long way to go and there's a lot to do.
So hopefully that has whetted your appetite to learn more about IFRS 9. And please do read our in-depth documents. We have 2 publications, one on impairment and one on classification and measurement, which you will find on our webpage. And actually they give a lot more information on this whole new standard that we've been able to cover in this webcast today. Thank you for listening.